Hello everyone, welcome to today's webinar. We're going to be still talking through the business structures for your family farm. My name is Jodie Knowlton, I'm Associate Director in our Business Services area, and I'm joined today by Andrew Jones, who is a partner in our corporate tax team.
Good morning. Good morning, everybody.
Andrew and I focus on the food and agri industry, and we work closely in relation to finding solutions for our clients. So structuring family farms and business operations is one of the things that we work closely with on a day-to-day basis.
Yeah.
So today, as a summary, we're working through the structuring process for family farming businesses. So there's a lot involved in the structuring process, and today we're going to be running through the high-level process to be undertaken and the different considerations for the different structures that are required within the family farming businesses. It's going to be fairly high level, but just so that everyone can get the key understanding of those key points that we need to factor into the structure. You can't just walk in and go, there's a structure that'll suit every family business and family farming business, especially around the place. So this webinar is to give everyone on the line those tools to start thinking about what those factors are and how we can help on that process. So let's dive into the process. So first of all, today we're going to work through what are the structuring options available, both informal and formal. So understanding what the entities are, what they do, how they work, how they interact, and then what some of the informal commercial considerations are around structuring for family businesses. So once we've identified, what the structures are, the next thing is then, what are the key attributes within these features, within these structures that are available, and which ones are relevant to our client situations or to your situation in relation to which structure would work best for you. Weighing up those attributes and going which one outweighs which, and then selecting the most appropriate structure on that basis.
Yeah, thanks, Jodie, for that introduction. And I think a traditional tax answer to any question is it depends. And we find sometimes that structuring family farming businesses leads to a very similar result. By way of metaphor, it's a little like choosing a car, and depending on what you want to achieve and what your structure needs to be able to do for you, your family, your objectives, assets, and so on and so forth, will largely drive how we consider the structuring process. So you might want to have a luxury Range Rover, so could be like a full detailed family trust structure with an operating company off to the side. You might want to have a sole trader, which will get you from A to B, but maybe won't last you for a long time, depending on how you grow. The Aston Martin up there, lovely vehicle, looks very attractive to an investor. And that's something that we'll speak about later in the presentation in terms of being investor ready and what structures that we need to do to consider. Or you might need just a utility workhorse, which will meet your everyday needs for as long as possible. So in summary, we like to bring to our structuring discussions a mindset from the beginning as to what is the purpose and what is the end goal. So very quickly, and this may not be news to everyone on the webinar, but we wanted to just cover off in a very brief way what are the general business structures. So we have sole trader carrying on a business, we have a company carrying on a business, it might be owned by a trust or by other individuals. The trust itself could carry on the business or own assets, or we could have a partnership of individuals or a super fund. So they're our sort of standard toolkit in terms of developing structures for farming businesses. So as mentioned, the exit strategy is very important to understand. What are the current needs? The scale of the business is something which is relevant also to consider. A small scale business might justify a simpler structure, but equally, if the business is small scale today but expected to grow rapidly, we should take that into consideration for how we structure. will there be off-farm income which is required? We often find that in farming businesses where, especially in early days or in bad seasons, off-farm income is necessary, and the structure that is chosen ultimately needs to be able to support that as flexibly as possible. And then ultimately, I think that one of the other considerations that we often see is what kind of entity do the key customers or suppliers want to be able to see. So that's often not clear at the start of a structuring discussion, but it's definitely something that needs to be borne in mind when considering the overall layout. So Jody, could you take us through the case study concept that we have in this presentation?
Yeah, so as part of the presentation today, we're going to run through 3 different families. So as if they've come in to Andrew and I, we're sitting down and we're working through what would be the best structures for these different families. So the first one is the Smith family. They're looking to acquire land to plant a macadamia farm, and they'll harvest the nuts and sell them to a local processor. So that's a high-level brief that we've been provided with to start with. NQ Feed. So this is 2 cattle-producing families that are coming together because they've seen an opportunity to establish a feedlot in North Queensland to process not only their cattle but also other cattle in the region. And then there's Mr. Williams. So Mr. Williams is wanting to lease some land and establish a Wagyu herd. He's going to start with about 200 F1 maiden heifers and then build the herd to at least 2,000 breeders at this stage. So that's what they've come into us as an outline of the case study. So we'll be referring back to these throughout the webinar today.
And building out additional facts as we try and unpack how we structure them.
Yep.
Yeah.
So the first thing, like what Andrew said before, is when these people come in and sit down and we talk about the structure, the first thing we asked is, what is the exit strategy? You know, what are they intending to do with this idea that they have? A lot of people see an opportunity and then don't necessarily think about where that end position is going to be. Is it that they're wanting to, sell the assets down the future, build a business up and sell it? Are they wanting to get potential investors in, third-party investors to then to work with the business or grow it further in the future? Or are they not wanting to sell it? They're adamant that they want to leave it to the next generation. They're just trying to build their portfolio, their wealth, and set up their family for the future. And if so, then who is that within the picture of things? So that's the first question that we'll be asking them. The next question in there is going through what type of assets are going to be within these structures. So will they be applying, will they be looking for capital growth within the business, or is it revenue growth from, in land increasing in value or building a business that then has a revenue stream coming through it? What's a holding period? Is it going to be short-term or long-term holding periods in relation to the trading activities within the business in its own right? And then also for the entity as a whole. And then the third one is what's the risk associated with the business now and then also in the future?
And Jody, I suppose it's a relevant consideration here too with regard to the assets as to who holds the asset now, particularly if there's a generational change in a farming business. Is that what we see frequently?
Yeah. It's understanding where are those assets sitting now, and if there is components of that asset pool that's coming into the structuring discussion, how is it there, and then where, if we need to move it, or how can that interact with the structure that we're going forward with?
Great.
So in relation to the case study, referring this back, once we've asked a few more questions in there, we identify that the Smith family has a long-term association within the macadamia industry. They already have one large-scale operation and want to expand their presence. They also have 2 sons and 1 daughter. So the intention, like we were saying before, is that they're wanting to create a legacy. They're wanting to build the wealth within the business to hand over to them in the future. In relation to NQ Feed, At this stage, they weren't sure, so we dug a little bit deeper on them and found out that they're in their late 50s. They're probably not wanting to be working within this business in more than 10 years' time. The Roberts family has a 23-year-old daughter who's currently studying ag science, but who may be interested in the business in the future. And Mr. Roberts has said that he'd like that to be the case, but he doesn't know what she wants to do. Whereas the McDonald family has 2 children at the moment who have established careers off farm and outside of the ag industry that are not really interested in running this feedlot going forward. So their exit strategy on that basis then is that they're going to want to potentially look to set this up to sell. They can't rely on the daughter for the Roberts side of things to want to step in there. So if we're setting up a structure, they've asked us to then work on the fact that they're going to build this to look to sell it in probably 10 years' time. Mr. Williams, 24-year-old, single, had inherited some capital and is going to use that to hopefully build a paddock to plate brand who'll generate income in the future. He wants to have the cash then to be able to buy his own property eventually instead of leasing it like he said before. So, so that's something to factor into the structuring discussions. Also being aware that there might be some possible local or international investors' interest in this branded product in the future. So having that ability to potentially be able to sell it if that then gives him the option to be able to exit and have the capital to buy the property that he's looking for. So if we're then applying this to the different taxing considerations in relation to exit, so we the factors that you'd normally look at from an exit strategy and the taxing side of it only is around the capital gains consequences upon exit and the stamp duty consequences. So if we look through this slide here, we can see that there's a availability within the tax legislation that if you hold an asset for more than 12 months and it's on capital account, that you can apply a 50% discount to the capital gains once that arises, 33% for a super fund. This is not available. This is available in the sole trader partnership trust structure, but for a company, this is only available if you sell the shares within the company, as opposed to if you're selling the underlying business within a company structure. Similar, stamp duty is payable by an acquirer within a business. So having a structure that if you're looking to sell it in the future, that could cause a stamp duty consequence for a potential purchaser may be a hindrance in the sale process and may make it a bit messier. In relation to like a sole trader or partnership business, anything that you sell, there'll be stamp duty in relation to that. If you, in relation to a trust, then the sale of the units would more than likely be subject to stamp duty. In a company, if you sell the shares within a company, there is a potential that there may not be stamp duty, but if it's a land-rich company, then that may kick back in there. In relation to, and from a stamp duty purposes, there's potentially stamp duty on that. One of the things I want to say when we're just talking about stamp duty, it's worthwhile noting that the stamp duty rules vary from state to state, and they are very specific in there. There are some state exemptions offered in relation to the transfer of land that's used for home production, and also in relation to succession planning processes that could be undertaken for the transfer of land. But it's very specific. So whenever we come up with an exit point strategy, we always get our indirect partner involved in it and make sure that we're understanding which state we're applying it to and what assets are applicable there. So, but this is just a high-level snapshot of that stamp duty, something to consider. So if we then apply this to the case study in here, we've got the Smith family. It's not really as important in relation to this structure because they're not intending to sell it. but keep in mind that they're wanting to buy land, and that could be eligible to have the 50% discount if they do ever choose to sell it in the future. For NQ feed, this is an important factor because the exit is going to happen in 10 years' time. So knowing that that's going to be, well, knowing that that's the intention with the structure that we're going to do. So being aware that we need to set up the structure to have it ready for sale and be able to access those discounts where we can for the 50%. And also that the stamp duty may be applicable in there upon sale unless we had it, the business operation within a company structure.
Sorry, Jody, I thought I might just jump in and also just mention in terms of the exit strategy with capital gains tax, some of the other factors that we think about that may be relevant is non-resident investors. They can have different 50% discount outcomes. And also on exit, we often have an opportunity to consider whether the small business CGT concessions are available, which can often substantially reduce the taxable component of capital gains where the base requirements to get those concessions are met. Just wanted to point that out on the way through.
Yeah, no, thanks for that, Andrew. That's good points to bring up in there. Also in relation to the exit strategy, this kind of falls into also the estate planning and succession planning considerations. So it's good to note from this slide here that within different entity structures, there's triggers that occur if there's if the business ceases with the death of the key controlling party. You can see in there that, you know, sole trader and partnership, yes. The trust and company, no, and the super fund, depending on who the members are. So they're good to keep in mind from a succession planning point of view. Also, who is the ultimate controller within these structures? You know, the sole trader is the individual, but the partnership, there's joint and several control and joint and several liability within the two partners. The trust, the key person who controls this is the appointer. A lot of people think it's a trustee, but looking at the trust deed and seeing who the appointer is and what happens on that in the event of of something happens to that person, that's the key controller of a trust. So that means that it can be changed if it needs to be. The company, the directors have the say as to how the day-to-day operations are operated, and they can be changed with no taxing consequences at all. So if we then apply that to the case studies in there, we've got that if say the Smith family wanted to own the land in a discretionary trust, then control of that trust can be passed to the beneficiary, to other members of the family if they wish to, either as part of the estate or as part of a succession planning process that could be facilitated prior to the death of the key party within there by changing, you know, that appointer role and or the trustee in there and having some planning around that. In relation to NQ feed, it's worthwhile noting that if something happens, there's a partnership, there's two parties coming together in business here that are independent people. So having agreements in place, shareholders, partnership agreements or unit trust agreements that then say what happens with the control or their control within these structures is really important. You don't, if you're going into business with a third party and something happens to someone, you could end up being in business with their family, which we've seen can be quite messy in there. But having that and having those mechanisms in there that upon death of a certain party, then ownership can change or triggers be put in place is something that we talk to our clients about and usually get lawyers involved at that stage as well. So also worthwhile noting on this slide is that succession planning and estate planning is not, from our perspective, is not a structuring exercise. Usually when we work with clients that have a key succession planning process, we would first sit down with the family, understand who each of the members of the family are, where they are, whether they want to be in the business now or in the future, and how they're going to interact together to be a joint family business and operate together now or and when something happens to the key parties in the matriarch or patriarch of the business. And we see this a lot, obviously, in family farming businesses. So once we've sat down and had that discussion, then the structure kind of falls out, because a lot of the stuff that we're talking about with Andrew and I today, we go through this with the whole family and understand, what their plans are and how they're trying to do it. And then the structure is the last exercise that we do as part of that. And if a restructure is required or anything like that, then that's what we undertake. So.
Great. Okay. Thanks, Jody. So I'll probably just pause here just to point out, with regard to the case studies, we'll, at the end of the presentation, bring all of these facts together. So I appreciate that we're sort of flashing up additional pieces of information as we go through, but it will come together in a coherent whole. And also should point out, we're happy to take questions and we'll respond to those at the end of the presentation. So for this next part, what I'm going to speak through just regarding the differences in structures is how different types of income broadly are taxed across the different structured types. And there are key differences with regard to the various structuring options, and where we sort of differentiate income is it going to, are the structures going to be deriving trading income, or are they going to be deriving passive income, or is it going to be a combination of both? So to put some structure around that discussion, here's some additional facts on our case studies that we've elucidated from our clients. And the Smith family have told us that the existing farm is on land which Mr. Smith inherited and which he's proposing to rent to a trust. And they're thinking that the business will operate out of the family trust. He would have revenue in his own name from rent in that case. The land that he inherited, we'd probably want to consider whether it's pre-CGT. The succession planning will be an issue for this family. With the NQ feed partnership, the family trust's assets that's accumulated over the years represents the key part of their wealth. So the question is, how do we access that in terms of designing this structure? Are there any UPEs, Division 7A loans? These can be real issues that we have to deal with as we go through this process. And what risks are there around the proposed business that might make it unattractive to operate in a wealth accumulation vehicle? With Mr. Williams, there's no existing business structures, currently works as a jackaroo. He's expecting that there'll be no off-farm income required once the business starts. So with those additional facts in mind, I'll just leap into the key differences between structures with regard to the income sorts. So I guess with regard to trading income versus passive income, the main point to draw out here is that superannuation funds are really not suitable to operate trading businesses because of the way that the rules for the superannuation environment work. So passive income only in super fund structures, so land holding, other passive asset holding. Outside of superannuation, any of the structures are suitable for trading income. The tax rate is, the taxable income is derived generally for a sole trader in the hands of the individual sole trader. Equally for a company derives income and it's taxed in the company. However, for partnerships and trusts, income essentially flows through those vehicles and it's taxed in the hands of the underlying partner in the case of the partnership, or in the beneficiaries of the trust who receive a trust distribution. a trust doesn't need to distribute. The issue with not distributing income from a trust is that it's taxed at a penalty rate equal to the highest marginal tax rate. So wherever possible, it makes common sense to avoid undistributed trust income. Now that creates an interesting situation if you want to accumulate income in a trust environment. It doesn't work. If there's an accumulation requirement, a company is the way to go. Dividends that come out of a company, just to round that conversation out, are taxed in the hands of the recipients, with potentially franking credits applying to reduce the tax. Down to the tax rates, the individual tax rates would apply to a sole trader. The marginal tax rates for individuals would apply. Equally for partnership, as I mentioned before, the income is split between the partners, generally going to be based on the partnership agreement and taxed at their tax rate, whether individuals, marginal rates, companies, corporate tax rates. Equally so for trustee, noting that on distribution, the trustee will determine the income split. Superannuation fund, the tax rate is 15% in most cases for a complying superannuation fund, 0% where the fund is in pension phase. We don't see too many non-compliant funds, but in the event that that does occur for whatever reason, usually inadvertent, the super fund is taxed at the top marginal rate. The company tax rate for a base rate entity, so that's an entity with turnover of less than $50 million on an aggregated basis, the company and its controllers and associates. If the turnover is less than $50 million, the corporate tax rate is currently 27.5%, and that is legislated to decrease to 25% for the financial year ending 2022. Base rate entity income is important to take into account here. That's essentially trading income or non-passive income sources. To the extent that the company just derives passive income from things like rent, the 30% corporate tax rate applies regardless of turnover. And that can be really relevant to consider, and it's also relevant to consider if a company receives a distribution of a dividend that flows through a trust, that can attract the 30% tax rate as well. 30% is also the tax rate for non-base rate entities, so turnover greater than $50 million. But for rule of thumb planning purposes, we generally work on the basis that a company is likely to be taxed at 27.5%, having regard to all else being equal. I guess the key point to take away from the business as usual taxation of structures is with regard to trading losses. And this is an important consideration in ag, given the seasonality of the sector and varying external factors. So tax losses, when they occur for partnerships, individuals and trusts, for partnerships and individuals, those tax losses are held out in the individual hands. And carry forward and utilisation of those losses is subject to meeting the non-commercial loss tests. A trust loss is carried forward in the trust, and the utilisation of that loss is possible subject to the trust meeting the trust loss utilisation tests. They can be quite complex, but the easy way around them from our perspective is for the trust to have what's called a family trust election in place. That's a planning point that we always consider where trusts are used. Superannuation fund, very similar to a trust in terms of the loss being held in the super fund. Companies, the slide says satisfy the similar business test. The loss utilisation rules in a company require the company to have maintained majority continuity of ownership, or failing that, the company is carrying on the same or similar business to the business it carried on when the loss was made, essentially. So that can present some issues in terms of if there's an exit involved or a change of shareholders, it's important to be able to demonstrate the history of the losses for that same or similar business test purposes. Just some other specific primary production concessions. and planning points. Primary production averaging is available across most of the structures that involve individuals or that can flow out to individuals. It's important to note companies can't access primary production averaging. So to the extent that companies are partners in a partnership, then primary production averaging would not be available. Primary production averaging is essentially just a way of making sure that the taxable income of a primary producer in terms of its taxable income is averaged over the years, I think 5 years, to ensure that seasonality doesn't create spikes or dips in taxable income. The farm management deposit fills a similar role. Contributions to specific bank accounts types present tax deductions for individuals. Again, not available for companies or for super funds. Research and development tax incentives are an interesting area when it comes to food and ag, and that could be a session on its own. However, important to note that only companies can claim the research and development tax incentives. And just to round that out, depreciation on horticultural plant is claimed down at the level of the individual partners, but it's available across all of the trading income type entities.
So Andrew, just applying that R&D concept just for a moment, if we apply it back to our case studies in there, because this is one of the areas that we see with a lot of our ag clients is the availability to actually, a lot of them are doing innovative things. So, you know, within the Smith family that looking to do new stuff within the macadamia industry, testing, using microbes, fertilizer rates, different things like that. There's some things that they might be able to look to potentially utilise the R&D. For the NQ feed, you know, the different feed rates or weight gains and different technologies or processes that may be eligible for that. And Mr. Williams, genetics may be something that he might look at from an R&D perspective, keeping in mind that to be able to be eligible to claim R&D, you've got to be, there's got to be something unknown when you're undertaking the activity. It's not something that the industry already knows that this is something that could be done that might get a different outcome, but it's going to testing or looking at things that are unknown at that point in time. So, but that's worthwhile to consider as part of these structures and stuff going forward.
Yeah, and that's a great point, Jodie. I think that R&D is something that can be really beneficial in agriculture. It's not going to happen in every situation, though, as you correctly point out. So I guess in terms of the other specific, the families in the case studies, what we'd be looking at for the Smith family with the land held by Mr. Smith, there's probably not a lot we can do there. He will receive passive income, and we might look at whether that land could go into a superannuation fund. But the trading income needs to sit out in a company, trust, partnership, or individual structure. With NQ feeds, the potential investor coming in tends to suggest that a company might be worth considering, simply from the perspective that the exit could involve the sale of shares in that company by the parties. Mr. Williams, at this point, I don't know that we have a clear picture, do we, in terms of what suits him the best. So there might be some latest facts that we discover from him, but we would be thinking along the lines potentially of a trust and or company, and we'll determine that as we go. One of the things that we take into account will be the risks. We've put down a list of the various risks, but the key issue that we want to draw out of this slide is personal liability. So a trust and a company really potentially give limited liability for the underlying individuals carrying on the business to ensure that they're not personally liable. It's worth noting too that at the moment there are laws which make directors of companies personally liable for certain amounts of unpaid tax, so pay-as-you-go withholding, superannuation, and from the 1st of April, GST. So that can be something that's very important to make sure that company structures correctly pay their taxes. So just a summary slide where we allocate the entities and assets. We like to think about whether they're high risk activities or low risk activities and allocate accordingly. So Jodie, can you take us through financing and how that drives structures?
So, like you've probably seen, the theme of the discussion today is all about, there's a lot of different things that come into play. So financing is one of them. It's understanding, which entities are requiring financing and for what purpose. Is it to purchase asset? Is it for working capital? In what entity structure would that be most relevant? And which ones of banks have more appetite to lend on these days as well? And like Andrew pointed out, he's talked about personal liability, but also within the financing side of things, personal guarantees we see a lot. You can put all the structures in the world to try and protect for asset protections and high and low risk and everything, but as soon as people start providing personal guarantees for financing and or just normal commercial terms, then that's where some of these structures come undone. Another thing within family farming operations is estate loans, because some of the funding within these entities can be done internally because there's wealth generated within the group. If that's held in the name or names of the matriarch and patriarch and something happens to one of those, that they pass away, then those loans that might be owed to them could be called in as part of the estate matter. So when you're looking at the structuring and or estate and succession planning, looking at where those loans are sitting and how that might play out if a nasty estate matter comes to play, then some of those could be called upon from other family members that may, the control of a business may have been passed across to one party, but they may call on a large loan that's sitting within the group to need to be repaid as part of that. So the structuring and how that commercial side of things is really important. So here's just a slide that says kind of the different funding options. The main point in this one is in relation to the equity funding, is that they're not available for the sole trader side of things. For partnership, you need to really set up you need to dissolve the partnership and create a new partnership if you're bringing in a new partner within it. The trust, you can't bring people in from an equity perspective into a discretionary trust, but you can a unit trust, and a company, yes. So this is the company structure is the most flexible in relation to bringing in additional equity funding. And then the borrowings, the internal and then external borrowings. And here, if you're operating through a partnership, that joint and several liability is really important. That if two external parties are in partnership together, then the one party may be called upon to pay the full amount of the debt if they can't recover it from the other party because they're in partnership together. Internal loans, a big thing Andrew mentioned before, Div 7A loans. This is where a company has lent money out to shareholders or associates, and that can be other entities within the group that's controlled within the shareholder base of that company. This basically requires minimum repayment and interest to be made on it. So this is something that can be utilised well within structuring and funding particularly, or it can be the undoing of a structure. So looking through how that plays out. So if we're looking at the funding requirements for the families that we're talking to, the first one, the Smith family, is requiring funding. They said they've got internal and external funding, but they're going to need it for both the acquisition of the land and also for the working capital for planting the trees and sustaining that through the seasonality side of things. NQ Feed will need the initial expenditure to acquire and build the facility and also working capital. Mr. Williams doesn't really need capital funding at the moment. He's got that, so he's actually already got that money himself. So it will be internal funding for everything, so they're not looking externally from that perspective. So as a summary in relation to the allocation of assets, you need to be looking at the whole picture. If you haven't got that from what we've been saying today, there's a lot involved. Integration of the succession planning, covering all assets and liabilities, not just the farming business ones, bringing into play other ownership structures, you know, tenants, common land ownership and everything like that, managing wills, managing risk, and just being flexible, because as we know in the current environment, things can change very quickly, and exit strategies can be changed.
And speaking about changing, as we mentioned at the beginning of the presentation, structuring the family farm can sometimes be a conversation about restructuring an existing farming business. What that looks like is essentially saying it's a planning exercise, is to say, well, what does our ideal structure look like, and how do we move from current state to future state? As I mentioned, small business CGT concessions and other CGT rollovers can be useful in managing taxes on restructuring family farming businesses. As Jody also mentioned in the conversation around duties, stamp duty concessions can be available for intergenerational transfers, and GST should always be taken into consideration. However, as a general rule, you'd look to make sure that GST transactions are exempt because of the way that they are structured. We have a couple of slides around share farming, which I'll go through in a moment, but share farming arrangements can sometimes result in CGT concessions in particular becoming unavailable simply because of the way that assets are used by the share farmer. So something just to flag as we pass through this restructuring section, and we have seen issues on that in the past. But generally, as a rule, we try and manage the taxes on a restructure as efficiently as we can. So with regard to the share farming, we have here trading between entities, share farming, leasing, land ownership in a separate entity operating business. Our recommendation is that there's a system to manage the costs between those entities. GST grouping is relevant. Rental arrangements, we always recommend that consideration be given to arm's length transactions. And this is in a situation where you would see a landowner having a passive income stream under a rental arrangement where the operating business is constructed in some other structure. So whether that be a company, another trust, a partnership, or something else. The tax office is particularly concerned that rental income is not inappropriately either under or overstated, and likewise that deductions for passively derived income are appropriate. And so our recommendation is always to ensure that as much as possible, appropriately arm's length arrangements are implemented. Share farming can permit older generations or generational change to be facilitated with ease. As mentioned, if the older generation person takes a very passive role in the overall business activity, it can jeopardize access to some of the CGT concessions. However, that's something that can be managed in the planning process for restructuring. It's also worth pointing out that if share farming or co-farming arrangements are contemplated as part of a family structure or restructure, it's very important to ensure that there's an understanding which is clear and documented at the outset as to how income and costs are to be shared. And this slide just builds further on that. I won't spend too much time going through the specifics around share farming arrangements. Suffice to say that they can be very beneficial, particularly where there is that kind of that co-farming intention or opportunity. And we're seeing a lot of that where we have a younger generation who don't have the capital up front to come onto the land. And that, if we tie it back to the case study, it could be something that Mr. Williams could be interested in if he found the right aspect. Equally, the Smith family with their Maccas, they could have a share farming arrangement too with the land that Mr. Smith owns, as long as it's structured appropriately. And probably worth also just pointing out here around the rules that surround the deductibility of holding costs for land which is vacant. Generally, there's no deduction if vacant land is held for the holding costs of that land, unless the land is used in a primary production business. That generally works, but sometimes we see some outcomes in share farming arrangements where it might not. So just to flag that as well on the way through. This slide is just to summarize some of the other considerations that we see, particularly with non-commercial losses, family members in the business and land tax exemptions. The land tax exemptions are state-based, and they're generally going to be based on primary production use of land. And we always recommend that there be specific advice taken if land tax is an issue. However, just be aware that there are exemptions for primary production activities. If there's an individual in the structure who is deriving losses from primary production activities, it's always worthwhile identifying the activities that generated the loss, and that can be a concern if the individual is undertaking multiple primary production activities. So you can have odd situations where you don't have proper offsetting of prior year losses because you've got different business activities. And finally, with family members working in the business, it's very, very common in family farming businesses. We just always caution to make sure that the appropriate employee matters are attended to, and in particular, pay-as-you-go withholding for salaries and wages. So there's now no longer a deduction for salary and wage costs unless pay-as-you-go withholding is withheld and reported. So very important to consider when employing or paying wages to family members.
So thanks for that, Andrew. So in wrap up to our presentation today, we thought we'd go through, because we've alluded to this structure all the way through it for the three different families. So the first one, the recommended structure for the Smith family, considering all the factors that we've had, is that the land be owned in a trust and it currently be controlled by Mr. and Mrs. Smith. The macadamia business be operated throughout a company. Share farming agreement be put in place with the market value of the rental arrangement between that, or the share farming terms within that. The macadamia business to be held in a different family trust to the landowning one. Now, this one here, that's not necessarily required. The reason we're recommending that one is to facilitate succession planning. One of the Smith's sons was not interested in being involved in the family business going forward. So there is a possibility there that he could receive a passive rental income coming through from that on an ongoing basis to enable the succession planning to flow through. But then the other children potentially run this new business and the old business either together or separately. So the structure allows that. In relation to funding, we'd say funding for the land, because that's you can get better LVRs in relation to the land and easier to get funding in relation to that, and the capital that they've got that within the business, look to use that for internal working capital purposes. So that's the Smith family in there. So then for NQ Feed, again, looking to split the land owning and the business owning entities, but the key point in this one is that we're setting it up for sale. So we're wanting to put in place a head co. It's just basically a company in its own right that then will own the shares in Land Co and Business Co. The idea behind this is that then we will tax consolidate the group together. So then if there's losses in relation to the establishment of the facility and also the ongoing activity, then we can offset those against each other and have it as a nice clean package for sale going forward. We're wanting the shares in Headco to be owned by the two a family trust, so the Roberts Family Trust and the McDonald Family Trust. We're wanting these to be new family trusts within the group. So that enables, again, separation of wealth within the family if needed going forward. Shareholders agreement is a must in this structure. This structure would also enable, will separate the business risk, will enable R&D activities if they're wanting to do it, because that's something that they were talking to us about. Funding of this, we said in the background information and the additional facts that there was large Div 7A issues within this group. So this then, by having that there, we can have the Div 7A issues that are sitting in companies and lend money across the internal working capital across to these company structures, because company to company loans are not subject to Div 7A. So that will help fund funds through the group and sort out that problem that they've got as well. So then with Mr. Williams, we'll be looking to run this through a company structure. Was considered as to whether you do it in his own individual name or a trust structure, but the weighing up factor in this one was more that he's wanting to reinvest the profits at, that 27.5 cents in the dollar, and have that working capital to be able to build his herd. Also, he's potentially looking to sell or bring in external investment in the future in this to then build it. So if he can get a brand up and going, then this is setting him up for success. So having in that company structure enables that to happen. And noted in there is that the company to be owned by a discretionary trust to provide flexibility in the future as to whatever his family circumstances may become.
Okay.
So that's a wrap up for the webinar today. The key stuff that we've gone through is, understanding the current structures that are in place. What's the exit strategy for each separate entity and business within the structures now and in the future, separating those high and low risk assets, managing the wills, power of attorney, director appointments, setting up the right processes between the inter-entities for share farming arrangements or any other commercial activities that are happening between entities, ensuring they're at arm's length, and then keeping track of are all these facts still relevant going forward? So touching base with the clients and going on an annual basis, is this still the objective? Are we still working towards where we're wanting to get to? And making sure the structure is appropriate for that.
Yeah, great. Thanks, Jodie, for the summary there, and that really brings us to the end of the content that we had to deliver. As we said at the outset, we tried to keep this at a fairly, I wouldn't say basic, because there's some conceptually complex things, but we wanted to present as much as possible all of the information that we can think of about how to structure a family farm. So we hope that the conversation has been helpful. Please feel free to type in any questions on the question pane. We've had a couple come through. So can the structure be changed after 2 to 3 years for a family farming business? I think the general answer is yes, that yes. Can be something that is looked at. So
yes, it depends.
But as we said, it depends. So as mentioned in the restructuring section and throughout the presentation, structures that are suitable on day one may no longer be suitable depending on life changes, business developments, a whole range of factors. So yes, a family farming business which is structured as maybe initially a partnership of 2 individuals who are operating on some land which is owned by their superannuation fund, that might not look like it's very suitable in 5 years' time when they suddenly have massive turnover, a branded product, and an outlet through some chain stores. Things like product risk, things like public liability, they might all point to high value of assets, succession planning. They might point to a completely different structure, and that can be changed at that point. We'll make a copy of the webinar slides available. It also has been recorded, so feel free to listen to it again. Jodie, did you have any other questions in terms of what things we might look at for family farming businesses in general? Are there any? What's your key takeaway point?
My key takeaway point in this is that every family farm business is different, and what's important to one and what's important to another is different. And even though structuring and tax and everything's quite boring to a lot of people, what I enjoy is actually understanding what's going on for the family and then working through a solution that will work for them now and in the future.
Yeah.
So that's kind of my key takeaway is really understanding what the key drivers are for the business.
Yeah, excellent point, and I think that's the critical message. Hopefully that's come through our presentation is look at all of the factors. I think from what I do as a corporate and international tax advisor, I'm quite interested in businesses that are looking to get investor ready, and so we look at getting a structure together that's suitable for attracting external investment, whether that's by way of equity or some sort of debt funding, and things that we see in that that context, I suppose, are Division 7A loans that might have accrued over years. We have to figure out a strategy to deal with that. We might have diverse land holdings and business operations which have evolved, and so how do we centralise a holding? How does that need to look? And as I said before, if there's losses, how do we best deal with it? So
Andrew also assists with if we've got clients who are looking to set up overseas because their products then grown or their business has grown that they want to expand into different countries internationally. So that's where Andrew comes into play as well.
Yeah, some export markets. Well, at this point, we don't have any other questions that have come through on the question pane. But Jody and I are both more than happy to answer or any specific questions after the session. Our details are on the screen. If there are any questions, as I say, or anyone wants to have a chat about any of the content in greater detail, we'd be very happy to do so. But at this point, we'll round out the webinar. Thank you very much for your attendance, and we hope it was useful to you today.
Thank you, everyone.